Hey, everybody, welcome back to another episode of What's Going On in Banking. I am Ron Shevlin, Chief Research Officer at Cornerstone Advisors and author of the FinTech Snark Tank on Forbes. And with me, of course, is my colleague extraordinaire, Stacey Bryant. Stacey, how are you doing?
I am fan flippantastic, Ron. How you doing? What's going on with you?
Great news to share with you. I am off the road. 6 weeks, six board meetings, four conferences, two breakfast presentations. I don't know how we're going to get through this podcast because I am pretty much brain dead at the time at the moment. But how about you? Been on the road traveling?
Yeah, I touched the conference and then getting ready for a few. It's funny, I sent you an email about a week or two ago and you're out of office, said another day, another conference. And the way that I chuckled, Ron, was yeah, I can hear you. But yeah, I a couple of weeks back, I was at the Cross State Connect annual conference in Bethlehem, Pennsylvania. And this is basically, it was a credit union conference for New Jersey credit unions and Pennsylvania. And a couple of trends, a couple of takeaways were small credit unions were merging with other small credit unions to become mid-sized credit unions. Mid-sized credit unions were merging or were in talks of merging with other mid-sized credit unions or even small ones to become regular. I mean, yeah, a bigger. And all in all, I was seeing that trend. And then I also saw a lot of credit unions who were interested in what about AI? How do I leverage AI? What are other shops? I feel like there's a good fraction of credit unions in that specific conference that they didn't want to be that first move. They did not want to take the first move. They want to see exactly how other folks are using it. I had a conversation with the CEO at a 600 million asset size shop where he mentioned, hey, outside of chatbots, what else can we do? And he mentioned, how can we leverage? We have all this data. How can we leverage where our consumers are shopping and where our consumers are borrowing from? So those are maybe I'd say three biggest takeaways, right? Small credit unions merging with smaller ones, mid-size merging with other mid-size ones, and outside of chatbot, what else in the AI space that folks can get their feet wet? How about you? You've been talk to me. What have been your takeaways in the past couple of weeks?
So, despite the crazy travel schedule, there has been one saving grace to all of this that out of the six board meetings I got to present at, five of them wanted me to talk about the same topic, growth. The sixth one came to me and said, I want you to talk about AI, and then came back like halfway through, right before the session, and go, oh, can you also talk about growth as well as AI? It was like, okay, yeah, we can mash those two things up. And so, I mean, clearly, and this has been a case now for easily 18 to close to 24 months, top of the agenda is deposit gathering. And, I posted something on LinkedIn last week, Stacey, and I hope people saw this. It was the picture of the elephant with the blindfolded guys kind of all touching. And that kind of is what I feel like the vendor space is around deposits. Our clients, our mid-sized banks and credit union clients in particular, are getting hammered and bombarded by tech vendors, services vendors, all telling them, "Hey, we can help you with the deposit gathering." And then when you look at what they do, though, they're really addressing a small segment or aspect of the whole population. And I think this is putting them into a spot where they kind of have to figure out what the ecosystem looks like and have to do a much better job of prioritizing where they want deposits from. Are these going to be quick hit type of things where they can get things done in 3 months, or is it more of a long term kind of solution? I've always been ticked off somewhat when our clients come to me and go, "Hey, Ron, any good ideas for how we can gather deposits?" And I'm always thinking, "Yeah, how about this? Raise your rates." And they're like, "Whoa, no, no, we don't want to do that. We don't want to raise our rates." I'm like, "Okay, then what do you want to do? Spend a couple $100,000, maybe a couple million to build a new capability. It's going to take you 12 to 18 months to deploy. Or do you want something that's going to be quick hit?" So it feels to me like there's this need for deposits. There are a lot of vendors coming to the table with solutions, but it's kind of a mess out there, I think, in terms of the sense that the FIs have to make of the whole situation.
Well, I think everyone, whether from a fintech's perspective, right, or a CEO from a bank. I think everyone is pretty much trying to find when you think about growth, and that's one of the biggest rocks that we always hear. You just said it right now. They want something tangible. And I think that's what they were trying to get. Like, what can we get out of Ron, the leading researcher in financial services that can help us move the needle now? And I think it's like the chicken, what comes first, the chicken or the egg? It's like setting a precise plan of attack and then literally reaching those milestones so you can see movement. So, what is it? Those marginal gains, right? The atomic habit from that book. It's like a little bit goes a long way. And I think that I like to say that sometimes folks are distracted by so many other innovations and so many other use cases and so many different types of AI that I think they look to you, Ron, to tell them exactly what is it that they need to do. So consider that a compliment, pal.
I will, absolutely. Hey, couple of news things I wanted to chat with you about. Big news in the banking space is the asset cap for Wells Fargo has been lifted. It probably feels amazing for them after I think it was 2018 that the asset where they got it. So 7 years. Oh my gosh, 7 years. And there was an article in the Wall Street Journal that said that the real impact or negative impact of this is going to be on regional banks. And I kind of thought, I don't know about that. I think this is going to be tough for a lot of the banking ecosystem as well. Do you have any thoughts on this? I've got a few I'll share after you jump in.
Yeah, Ron, thank you. I agree with you. I think this is a Wells Fargo comeback tour from regulatory timeout to main stage for sure. I was reading, so just to kind of give the folks and people listening some insight. So you called it right back in 2018, the Fed imposed a 1.95, yeah, 1.95 trillion cap on total assets. Why? Because this was during the whole scandal of a whole bunch of their employees opening up unauthorized accounts, right? Signing folks up for unauthorized products because they had very aggressive sales target, and it was at that time that the cap prevented the bank to not expand its balance sheet, right? That's what it was. So basically, limiting them for not taking any new deposits, more loans, or even grow through acquisitions. And now 2025 has been the merger and acquisition year for me thus far in observing it all. So I think that you mentioned outside of regional banks, I think on our last episode, and even the episode before that, how, between Chimes S1 and between just other folks literally Discover and Capital One and making these very intentional acquisitions just to literally dominate the market, right? Where not only regional banks are in play, community banks are in play, credit unions. So I think that quite honestly, regional banks are betting on tech to avoid becoming collateral damage. And I think now more than ever, this is when we have to kind of observe a little bit about what's happening and what they can possibly do in part of their strategic plan. What data do they have available? I think that Wells Fargo, similar to even Chase, they're taking a card out of the community bank's hat as far as like penetrating the community, looking into small business. So now more than ever, let's look at tech stacks. Let's look at how else we can go ahead and attract the Gen Zs, attract, small business, as I mentioned. I don't know. What do you dive into that a little bit more for me, Ron?
Yeah, I think you just touched on the key point from my take, Stacey. One of the things that has surprised me, and we've done a lot of consumer research over the last 7, 8, 9 years, and we continue to look at who consumers open accounts with and who they consider to be their primary financial institution. No, stop. That's wrong. It's not who their primary financial institution is. It's who their primary checking account or payment provider is. And one of the things that has just totally blown my mind is despite all these scandals, consumers still open up accounts with Wells Fargo, still consider them their primary checking account provider. And so if you actually look at Wells Fargo's deposits over the last 7, 8 years, it has not declined. I mean, and obviously there's been a cap, so they've not been able to grow much more than 5%. But what's interesting is that they've done actually a very good job of retaining the consumer deposits and letting some of the corporate deposits, which are higher cost deposits. So they've actually done an amazing job of managing their profitability around the deposit growth. And I think what's going to happen now, and you touched on the small business, I think it's small even to medium size and perhaps a little bit larger. Now they're going to go aggressively after that business. And, the small business often is the bread and butter for a lot of community banks in particular. So I do think this is going to be a tough row to hoe for some of the mid-sized institutions, as well as starts to get a lot more aggressive about deposit gathering, not just on the retail side, but in the commercial side. And that's they're going to be tough.
So, Ron, can you open up a little bit on? I was reading as far as like, okay, so what did Wells Fargo have to do to get this cap lifted? And I read on here that the Federal Reserve basically there were four markers here. So, overhaul its board governance and risk management frameworks, make significant improvements to compliance and operational risk programs, undergo a third party independent review of its reforms, pass direct evaluations by the Federal Reserve that have been literally validated by both Fed Reserve and the third parties that they've used. So provide layman's terms, like after 7 years, right? And I know, what was it, Charlie Scharf, right? Their CEO that was appointed soon after the whole scandal, I think in 2019. He's credited with providing like this comprehensive spin to having had the cap lifted. But what does that mean as far as like, can you provide a few examples as what they had to do in their processes that can now open this up for them?
I think it's just a lot more transparency from a regulatory compliance perspective. I think, behind the scenes, Sharf's done an amazing job of just getting the management team in order and aligned, and would not be surprised if there have been, a lot of quiet departures from some legacy senior execs at Wells. I mean, I've worked a lot with Wells over the last 20 years, Stacey, and one of the things I've always found is that the folks I've worked with have always been super top-notch, high-quality bankers, who definitely were not part of any of the scandalous behavior. And I think Scharf probably just did a really good job of behind the scenes cleaning house, getting stuff in line, and I think very importantly, aligned. And so, 7 years is a long time. I think the environment there is very different. I always think there were really only a few bad actors and bad apples who were causing these problems in the first place. So probably shouldn't be too surprised. I mean, I think it's about time that they got the cap lifted, and I think we're going to see a much different Wells Fargo kind of emerge. One that's, you can argue whether or not they've learned lessons. There's always going to be folks who are going to jump all over LinkedIn and tell me how wrong I am, though they're still an evil player, all that kind of stuff. But I think they've done a much better job of getting things aligned, and I think we're going to see a pretty aggressive push from them. And I do think it's going to hit not just the regionals, but a lot of the community banks.
Yeah, I'll say this one last thing before we switch gears is, you mentioned just some of those bankers who were just these traditional bankers who understood the foundation, right? We think about financial literacy, we think about the new generation, and these folks, especially with the amount of access that they have and capital that they can probably get this right. Like I can see them be just even a major competitor to Chime. So I wonder what this would look like a couple of years from now and compare notes.
Well, I may argue a bit with you on that one.
Yeah.
Because look, Chime's market is clearly the low to middle income consumer. And I think the big banks in particular are happy to let somebody else take that. I think they don't see it as particularly profitable. I mean, Chime's done a good job of driving a lot of payment activity out of it, but I don't think that's Wells's bread and butter and where they're really going.
Got it. Got it. Got it. Well, talking about credit and subprime credit, let's talk about this whole buy now, pay later advocacy.
Yeah, I wanted to share this research study that I came across, and it came out of all places, the CFPB, looking at buy now, pay later. I guess they got a data set, de-identified credit cards and debit cards and so forth to look at from six of the leading buy now, later providers. And I think my headline for this, Stacey, is bad news for the BNPL bashers. And there are a lot of folks who love, especially in the industry, just love to bash buy now, pay later as just, contributing more to consumers' debt problems and all of that. And what I think what surprised me a lot was, remember now, the CFPB is hardly a financial institution provider friendly bureau there. But here, let me read this to you. This came from the study. I just saw it. It was published just this week, I think. It says, we find that borrowers increase their buy now, pay later balances 1 quarter after their first application, but the increase dissipates over time. We do not detect analogous increases in non buy now, pay later debt balances and find some evidence of substitution between buy now, pay later and similar loan products. The results do not support a conclusion of negative impacts of first time buy now, pay later use on the ability of borrowers to repay non buy now, pay later loan obligations, nor on several measures of financial distress. So I think there's a couple of things in there that kind of really struck me. Number one, for all those buy now, pay later bashers who think this is only contributing, no, CFPB says not necessarily. I think also from the financial institution perspective, and I think mostly remember these came from 6 of the leading buy now later providers. So I'm sure that's Klarna, Affirm, PayPal, throw in a few others. The idea of seeing the substitutability means that consumers are moving away from, well, in good news for the financial institutions, probably moving away from some payday loans. So that might be a good sign if that's what's being substituted. But there also might be some substitution of credit card payments in there or other kinds of personal loans that are generally provided by the financial institutions. I have been on a rant for close to 2 years now telling financial institutions, you got to get into the buy now, pay later game. It's not going to be easy to do, and you're coming from a position of weakness because Klarna, Affirm, they get in before the decision is made, and generally the financial institutions are getting into it after the transaction's made and the financial institutions providing some buy now, pay later capability. But there are a bunch of providers in the space who are helping financial institutions with this, Stacey, and I think this is a study that they should take a look at and draw some conclusions about the impact on them.
Yeah. Just a few things here reminds me just like how buy now, pay later is like the new guy at the poker table and everyone's watching him, but he's not the one running up the tab. So I think that's in essence what you're saying. And I think when buy now, pay later, when I started talking to several credit unions and community banks who started to entertain integrating buy now, pay later onto their offering, so to speak. I think I was initially concerned with like the financial literacy part, especially, if you think about folks that have subprime credit. So immediately that takes me to the new generation for whatever reason or for obvious reasons. And I like to think about, I think I read between this article as well that some of these buy now pay later's expenses or loans rather are small. So think 135 to 142 on average, mostly for apparel, beauty products. I think I even saw it on on one of like the travel sites, right? Like the Expedias or what have you. So that's a bit of a different animal because of the higher expense. But all in all, I think that now buy now pay later. I know that one of its requisites is that it does require for you as a consumer to set up auto pay. So I think that this would be another avenue if you can offer this and beat it out against payday loans, right? At these like local check cashers who also offer this at a significantly higher percentage. This may be an opportunity to go ahead and maybe bridge the gap for these subprimers, so to speak, and maybe set them up for financial success. I'll say this again, having been in those shoes of helping consumers in financial literacy. I think that this is a tool. And I think that this tool, Ron, can be, as long as it's set up, it reminds me, when my parents gave me the whole, you're 18 now, Stacey, you're about to get a whole bunch of credit cards. This is not your money. Make sure that you already have the money in your account or you're about to get it before you make that purchase. So I think it's important that banks or credit unions or whomever is distributing this, or whoever decides to do to integrate buy now pay later. I think part of their mission statement should just be that. I think that now more than ever, folks to tap into, especially the new generation, tap into, okay, apart from my money, what do you stand for? So I think that that's what I wanted to add there, right? I know banks called it also shadow or phantom debt because a lot of the buy now pay laters don't appear on credit reports. So what do you even do with some of these purchases that have gone flung? But I think the default rates are dramatically lower than the credit cards. That's what I read.
Yeah, and that's true. And I think there's been a lot of debunking of that phantom debt,
Yep.
especially as more and more of the buy now, pay later providers are reporting to the agencies. There was a great article written by, I think it was the CFO of a firm, debunking the whole phantom debt, which actually came out of all places, a Wells Fargo article, a report, I should say. So, hey, I wanted you to, you shared something with me the other
Oh
day,
yeah.
a message that you got from somebody you know. And I said, "Oh my gosh, you got to bring this up on the podcast. Can you share that with her? And do not mention any names, please.
You
Keep
got it.
your friend anonymous here."
Absolutely. So just to kind of set up the stage, Ron, I know in a previous episode we spoke about just overall how I think I compared a community financial institution who they're looking to us to provide a data strategy, also data governance, right? There's an order to this: data strategy, data governance, data warehousing. However, this specific financial institution, their board specifically is cloud averse. So when we think about pretty much their even intricacies of a core product are now tapped into the cloud. So this person went on to critique our episode in a positive way, and they mentioned that their senior leadership team had AI strategy roadmap in place, and they went on to basically say that the journey towards AI, enables just so much success and so on and so forth. So here's the thing: the thing is that the journey towards AI enablement starts exactly as we outlined, right? Data strategy, governance, and warehousing. However, their shop does not want anything to do with AI. They said they, at this point, don't even bring it up. We need to focus on performance and excellence. We need to focus on metrics for success. And I think that if you are speaking about performance, and you're speaking about performance metrics, somewhere, somehow in the financial services industry, you need to speak about an AI strategy, a data strategy. This has to be included in every strategic planning, or else you're going to be dead. So, what are your thoughts there? I just wanted to kind of give it a high level there.
Well, your friend's quote that she went to the her boss and said, "Do we have an AI strategy?" And that person came back and said, "Do not bring this up because that you may not speak of that." I think was what she said, and it the just the I have such a hard time grasping what the thinking behind this is. And it kind of reminded me of something else that I just saw today on LinkedIn, that highlights this sort of lack of logical thinking. And it came from a post from a buddy of mine, JP Nichols, who I've known for a long time, and helped set up Alloy Labs. And he quoted a senior bank executive who said something to his colleague, and that comment was, quote, "We're not focused on any revenue generating activities at this time," which was kind of odd. But even better, as he wrote, was the reason was because we're building 12 new branches. So, in other words, his translation was, we don't have any time or resources to allocate to growth because we're too busy spending money. Now, I got to tell you, I couldn't help but wonder if this was just sort of a brush off comment to his colleague, who maybe this exec thought this was a sales pitch or something, and he or she was just trying to deflect it and say we're not focused on any revenue generating activities. But I told you earlier, I said, I'm coming off of 5 out of 6 board meetings where the focus was, Ron, what do we need to do about growth? And to hear some financial services and bank execs say, we're not focused on revenue generating activities, then pardon the language, but what the hell are you focused on then?
Yeah, yeah. So, but let's dive in really quick on what do you do, right? What do you do when you are an innovator? You are seeing the times change. You're seeing how instrumental it is to, even going back to the unknown listener, even going back to how, I know that with the data strategy, I know with AI strategy, I know even with, pumping in some money on literally being prescriptive with revenue. How do you, as a let's say a mid-level manager, how do you even convey that message to the powers that be? Because part of your job is to move the needle, Ron. So it's like, I don't know, it reminds me of Abbott and Costello. And yes, I know of Abbott and Costello. Who's on first? Like, who's on first here?
So, listen, I have an answer for that, but I got to qualify it, and that I don't think it's the mid level. I think the mid level execs are just stuck between a rock and a hard place on that.
Yeah.
But as an outsider, as an advisor, a consultant, whatever, here's the approach I usually take with this. And I've been doing this a long time. It goes back, I remember 20-ish years ago already, Stacey, when mobile banking was first coming out before the iPhone. And I wrote back at the time, I said, look, mobile banking is going to be huge, but you do not need to be putting a lot of money in it right now because you've got a lot of other things you've got to fix with online banking before you address mobile banking. There's three types of people out there, Stacey. There's the optimists, the pessimists, and the realists. And the problem with the optimists and the pessimists is that they think they're realists and they're not. And us realists, and we're really a small minority of the whole population, we recognize there's always pluses and there's always minuses. So I'm dancing around it here, but let me get to my point. The approach that I take is always, no, yes, you're right. This is really going to be big, but you don't have to put all your investments right now. It's a time issue. It's a time factor. You need to be looking at this 2 years from now is when you need to start doing it, or a year from now, or start experimenting small. I think the problem is you get a lot of the pundits, the analysts in the space who look at these technologies and go, oh my gosh, this is going to transform everything. And you have to change everything about your organization this year. Not the way it works. And so I think coming in with a little bit more tempered, time elapsed kind of approach softens it for a management team or board who's got their back up and saying, oh, we're not doing this. Well, you got to kind of just chip away at it. To me, it's almost unimaginable to think there's a management team or board who's, as you alluded to, cloud averse. Okay, I get the AI stuff because the pessimists are always telling you about how deep fakes and fraud are going to do all that stuff. Not that you're going to be able to stop that anyway, but I think you got to kind of chip away at their resistance and not try to convince them that they're completely wrong and have to transform everything day one.
I guess my only remark there is the assumption is, listen, we're struggling for deposits, we're struggling with growth, and what we're not going to do is tackle on and maybe incur a significant loss on something that maybe a lot of institutions are not actually using, right? So I think that now more than ever, it's important for everyone to be as open as possible and to share how they're using it. I know that I'll tell you on a personal level, when one of my dear friends, they created their own workout plan using the X amount of protein, grams of protein a day and their dietary restrictions, and they inserted it on Chat GPT. I was like Little Mermaid. It's a whole new world. It opened that curiosity, right? So we can maybe open curiosity regardless of our roles and see exactly to your point, maybe try it in like betas or with an X amount of people or X amount of consumers. I think that would be a good little use case, even internally, that can perhaps be adopted in the future. So just wanted to add that. Outside of that, Ron, I am getting ready to go back on the road. I will be at the Maryland, D.C. Credit Union Association annual conference next week in D.C. Soon after that, I will be down in Naples, Florida, for the Maryland and Virginia Bankers Association's annual conference. So, yeah, I'm going to be rocking and rolling, and I am so curious to see what these folks have to say regarding their big rocks, AI, and how they're integrating it today. So, are you going anywhere in the next? I know you say you just came back. Are you home for a couple of weeks at least?
Home for 2 months.
Yay!
Yeah, but I look forward to catching up with you in a couple of weeks. At the next episode, I think we should leave it here for now. Thanks everybody for listening in. We'll see you in a couple of weeks on what's going on in banking. That's nice, Stacey. Good seeing you.
Thank you.